Hi and welcome to Swissco's Daily Market Talk. It's Friday, March 7th. Trump posed the tariffs on Canadian and Mexican imports following a sanguine reaction from the markets around the world. But the hectic tariff policy news already fueled the recession. While bets for the US weigh on US equity markets and the US dollar, while on the other end of the Atlantic Ocean, the Europeans are looking for alternatives to replace some US services, resulting in big moves in unexpected stocks. Today, all eyes are on the US jobs data before the closing bell. Okay, so Trump posed tariffs imposed on Canadian and Mexican imports just 2 days after imposing 25% levies on its biggest trade partners' products, hinting that the same masquerade will begin again next month with reciprocal tariffs. Or maybe it won't, because the markets have been reacting quite sanguinely to these aggressive trade policies and these hectic trade policies, which are doing nothing other for now than hammering the US own equity markets while boosting appetite for making elsewhere great again, in a joint effort, for example, to decrease the European dependence on the US military and technology. And we also see some resistance from elsewhere in the world. In this context, apparently, the Chinese refused to take on the 10% price cut on their products that was asked to them by Walmart, that was actually looking to make its Chinese partners carry the entire burden of Donald Trump's tariffs on its own shoulders, while Europe is actually looking to replace Elon Musk's Starlink terminals in Ukraine by a European alternative. The French satellite operator Eutelsat's name is just coming up to make sure not to give the communication capabilities in Ukraine into the hands of a no ally anymore. So, Eutelsat is making crazy moves this week, to say the least. Its stock price gained more than 500% in just a week, even though there has been a certain pullback at yesterday's trading session. The European defense stocks, on the other hand, are consolidating their enormous gains near all-time high levels as the European countries agreed to spend 800 billion euros for strengthening their defense and security sectors, matching the amount that Mario Draghi had suggested around last September. Remember, to improve the old continent's technology, defense, and green transition, among other things. Now, I'm not really sure for the green transition part of the story, but the money will sure be flowing into the European defense sector. And who says defense also says technology. On top of it all, the European Central Bank delivered another 25 basis point interest rate cut at yesterday's monetary policy meeting, as expected by everyone, but hinted that the rate cutting cycle in Europe could gently be coming to an end after 6 interest rate cuts, as inflation is now approaching their 2% monetary policy target. Now, interestingly, the bank's latest inflation and growth forecast didn't necessarily include the impact of the upcoming massive government spending on defense, which should be at some point balanced out by stricter than otherwise monetary policy to keep the price stability in check in Europe. But the Eurodollar already cheered the news. It advanced past the 61.80% Fibonacci retracement level on the Trump sell-off. As such, the pair is now in a bullish trend with support to the latest rebound seen near 107.25 level, which is the 200-day moving average, 106.78 level, the minor 23.6% Fibonacci retracement, and 105.93 level, the major 38.2% Fibonacci retracement, above which the bullish trend will remain in play. On the equities front, the Stoxx 600 index closed yesterday's trading session near flat. Now, near flat was a great performance, mind you, because major indices on the other side of the Atlantic Ocean were actually hit by another wave of heavy sell-off. The S&P 500 lost 1.78% yesterday, tipped a toe below the 200-day moving average, and closed the session just around this level, while the technology-heavy Nasdaq 100 index slipped and closed below its own 200-day moving average yesterday. Now, you probably heard that investors are now looking for the level or the percentage of drawback in equity markets that would eventually convince Donald Trump to throw in the towel with his tariff policies, for example. So the letter is called the Trump put trade, if you missed that. So that Trump put actually looks to be the 200-day moving average. Maybe it's just a coincidence, obviously, because we can't just say by certainty that it's the Trump put. But Trump rolled his tariffs back when the two major indices in the US fell below their 200-day moving average levels. Now, even though the president says he doesn't look at the stock markets and the stock market prices to decide what to do, we know he does, and he probably knows that we know that he does care, because he is the first one pointing at the stock market performance when the stock market performance is great. Anyway, whether he cares or not, it doesn't really matter, because investors do care. The S&P 500 is the worst performer among the world indices so far since its inauguration. And inside the US, the low volatility stocks amass capital, like Invesco's QQLV ETF, for example, which includes low volatility names such as Coca-Cola, Mondelez, and AstraZeneca. The US dollar, on the other hand, is on course for its biggest weekly drop in 2 years, and the latest revision to Atlanta Fed's GDP now forecast points at a 2.4% contraction in the US economy in the first quarter of this year. And also the recession bets for the US are rising by the day. Polymarket, for example, now assigns a nearly 40% chance of a US recession this year. Yes, this year. That's up from below 20% before Trump took office at the start of this year. Meanwhile, the Fed is now expected to cut its interest rates more than previously expected to support the waning US economy, as long as inflation allows, of course. Will inflation allow, or how much inflation will allow, will probably depend on tariffs. Anyway, this morning, the market mood is a little bit better for the US equity futures. Broadcom, for example, jumped nearly 13% in the after-hours trading yesterday after the closing bell, after announcing better than expected quarterly results and also after giving a strong forecast. Now, this announcement couldn't come at a better time, to say the least. The company's stock price actually retreated to its 200-day moving average at yesterday's trading session on the back of a broad-based sell-off in the US assets that also pulled Nvidia to the lowest level since September as well. While the Chinese Alibaba extended its gains this week on claims that its new QWQ32B model performs better than DeepSeek's model, but with less data. And while we are here, JD.com also posted the biggest revenue growth in almost 3 years, while China announced this week the creation of a new bond platform to help its technology firms to issue onshore debt in a move to facilitate these firms' access to capital. So the CSI 300 index is actually preparing to close this week on a positive note, and that despite the tariff jitters. In the US, investors will be closely watching the US jobs data today. That is expected to print 159,000 new non-farm job additions in the month of February, with ideally slower wages growth expected on a monthly basis and a stable unemployment rate near 4%. But the risks are obviously tilted toward the downside, given the mass firings that we see at the US federal agencies these days and their implications for the broader economy and broader sectors. As such, a set of softer than expected jobs figures from the US today could further weigh on the US dollar, while the worst case scenario for the market today would probably be lower than expected NFP print combined with a higher than expected wages growth number, which would then leave the US Federal Reserve facing a slowing economy for the US with limited room to give support to this waning economy. So voilà guys, this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.